Hi guys, it's Henry from Investment for Expats, coming to you as of November 2023. So just very quickly want to talk about some of the top funds that I would use in my portfolio right now as of speaking, who they're for, and how particularly you may want to use them in your portfolio. So first off, we've got the Vanguard Treasury Money Market Fund. Now, this is a fund that's yielding actually real returns of 5.32%. It's for low risk investors, but you've also got a lot of investors that may be looking to put money in cash or cash equivalents that don't know where to go in the equity markets, or they see the equity markets as particularly volatile right now, and maybe don't want to dip their toes into the market. And why not, right? You're getting a real return in money markets. It's the first time what we've seen in for a long time. It's about 15 years that you're getting real returns. It's got the liquidity option. There's a reason in 2023 there's been a big influxation into money market funds. So this is my number one pick on where I would go into portfolio right now. So next off, we have the Invesco equal weighted S&P 500. Now, I'll just get this up for you. Now, this basically wipes off the Magnificent Seven of what we've seen in 2023. Obviously, if you look at the S&P 500, and if you were to go, into the ETF in the S&P 500, the way it works out is that it'll be market capitalization weighted. So therefore, Apple would be making up a majority of the S&P 500, therefore has more influence. And if Apple goes up, the S&P has more chance of going up with Google, etc. But if the reverse happens and they go down, the S&P 500 is more likely to go down. So how an equal weighted index works is, instead of having it more weighted towards the seven biggest stocks or the bigger stocks in the holding, it's equal weighted. So therefore, this isn't so influenced by a few names in the S&P 500. And also what we've seen in 2023 is the S&P that has been mainly dictated. If you strip out the Magnificent Seven, as they're called, it's been kind of stagnant throughout the year. So I believe that this is an ETF for those that want to get into the S&P 500, but also want to take out the technology stocks that some may believe are on too high PE ratios. Now, next up, we have the iShares Mid Duration ETF. Now, for those of you that may want to get into this, is because what we saw in October, or actually last week, was that the Jay Powell and the inflation data that came out predicting that potentially rates may be cut by, or analysts saying that rates may be cut by June rather than July. Therefore, you may want to look at expanding duration in your bond holding. This will give you longer yields and for longer. The US Treasuries is particularly one that you may want to go into. And finally, what we've got is one of the more riskier holdings that we've actually seen hedge fund managers like Ray Dalio go into. That's been actually a big advocate for a long time in this. This particular sector is the MSCI China Index. Those, particularly for those that believe in the longer term macroeconomics of China and believe they can get through this stagnation, the property problems that they have, the youth unemployment that they have, and can transition their economy from an innovative one, from a manufacturing one. I personally believe it can. I've written a number of articles on why I believe that China can come through this, going into a lot more detail into the population, how it's governed, etc. But do believe with it's down 10% year to date, it can be made up for a proportion of a portfolio for those that, one, have a longer time horizon, and two, the ability to take the risk tolerance, as what we've seen this year is investing in China, or any EM for that matter, can be quite risky. I hope you found this useful. Just a quick disclaimer that investments can go down as well as up, and none of this is constituted as financial advice. Thanks, guys. If you have more information, feel free to message me at info@investmentforexpats.com.